Japan just lit the fuse on a 250% debt-to-GDP bomb, and the shrapnel is heading straight for U.S. stocks, AI hype trades, and your mortgage rate. If you think Japan stuff is some distant problem, wait until you see how a policy meeting in Tokyo can blow up your portfolio in New York by lunch. So, quick setup. Japan has been the world's debt lab for years. Ultra-low rates, money printing, government debt piled higher than anywhere else in the developed world. For a long time, that experiment looked weird but stable. Now the lab alarms are going off. Here's where things get interesting. The Bank of Japan spent years keeping interest rates near zero, even negative, and buying ridiculous amounts of bonds. That let the government borrow basically for free, and it let investors borrow in cheap yen, then dump that money into higher yield stuff like U.S. Treasuries and tech stocks. That trade is called the carry trade. Simple version: borrow low, chase higher yield elsewhere, pretend that nothing bad ever happens. But now, something bad is happening. Japan's inflation picked up, the currency got too weak, and the central bank finally blinked. They started allowing higher yields and began shifting from "we buy everything" to "actually, we might sell some of this." When the lender who's been silently supporting the whole table even hints at standing up, every chair in the room wobbles. But then the unbelievable thing happened. U.S. Treasury yields spiked as that carry trade started to unwind. If Japanese yields rise, Japanese investors don't need U.S. bonds as much, so they rotate back home. Less demand for treasuries means U.S. yields go up. Higher yields hit everything that's priced like perfection, especially long-duration bets like AI growth stocks, speculative tech, and anything that assumes money will stay cheap forever. Here's the twist. The U.S. is also borrowing like there's no tomorrow. Over $1 trillion in treasuries held by Japan alone. So you've got Washington selling tons of new debt, Japan stepping back as a buyer, and global investors suddenly saying, you're going to have to pay us more to keep funding this. And here's where things take a step further. A lot of the money sloshing around those trades is not some old guy manually clicking buy in his brokerage account. It's algorithms, AI-infused trading systems that watch yield curves, volatility, and correlations in real time. When Japanese yields move, those systems don't debate policy. They just sell what their models tell them to sell. For years, Wall Street could rely on a comforting pattern. When stocks fell, bonds usually went up. That meant balanced portfolio actually meant something. But when the Japan-U.S. bond relationship breaks, you can get stocks down and bonds down at the same time. Your safe side of the portfolio gets punched right along with your growth side. But it's even getting worse because this isn't just about Japan and the U.S. You've got roughly trillions of dollars in global holdings of U.S. treasuries, including Europe. A lot of those are held by institutions that are highly leveraged. Think of it like this. They borrowed a ton of money to squeeze out small gains from safe bonds, assuming those bonds wouldn't move too dramatically. When yields spike, bond prices drop. When bond prices drop, the collateral on those leveraged trades shrinks. Margin calls hit. That forces selling, not just in bonds, but in equities, in emerging markets, and yes, in all the shiny I plays that were supposed to be the future. Forced selling doesn't care about your favorite ticker symbol or how cool the product demo looked. But then he said this unbelievable thing. Policy officials started dropping hints at global gatherings like Davos about concerns around the U.S. fiscal path and rising yields. Translation from diplomat speak. This looks unsustainable and we're nervous. When the people whose job is to stay calm on camera start choosing words like fragile and imbalances, you should assume the private conversations are a lot spicier. Here's where things get interesting. Let's bring this back to you sitting in the U.S. watching AI, politics, and markets. What does a Japanese debt shock actually do to your life? First, stocks. Higher yields are like gravity for valuations. The higher the risk-free rate, the less investors are willing to pay for future cash flows. AI companies that earn little now but promise big profits someday get hit hardest. That's why you'll see days where all the AI names drop at once, even when there's no company-specific news. The macro machine just said, time to reprice risk. Second, your mortgage and credit cards. As global demand for Treasuries weakens, the U.S. has to offer higher yields to attract buyers. Those yields set the baseline for almost everything else: mortgage rates, corporate borrowing, car loans. So a bond trader in Tokyo dumping Treasuries can, in a roundabout way, make your next house more expensive. Growing up, I watched my parents lose most of their savings because they trusted a professional who said, "Don't worry, this is safe." That dinner table silence lasted a lot longer than the market headlines. Same vibe here. Everybody said government debt in rich countries was boring and safe, until suddenly it wasn't. But it's even getting worse, because now we have AI piled on top of this. You've got AI models scanning central bank speeches, debt auctions, inflation prints, and trading off the tiniest phrasing changes. One slightly more hawkish word. Algorithms instantly shift from risk on to risk off. You don't need a human panic anymore. The code panics for you, just faster. That's why you can wake up to a calm market, see one surprise move from the Bank of Japan, and by lunchtime, the S&P 500, your favorite AI stock, and long-term bonds are all bleeding red. It's not magic. It's leverage plus automation, sitting on top of a mountain of debt nobody really wants to think about. And here's where things take a step further. So what do you actually watch from here? Number 1. Japanese government bond yields. When they move sharply higher, global risk assets tend to get nervous. Number 2. U.S. 10-year and 30-year Treasury yields. If those push back toward levels like 4.5% and 5%, that's the market telling you, we're not comfortable with this much debt at low rates anymore. Number 3. Correlation. If you start to see days where stocks and bonds both fall together repeatedly, that's your signal that the old playbook of just buy a 60-40 portfolio and chill isn't working the way it used to. Personally, I'm allergic to get-rich-quick narratives. In my 30s, I made my best money on something boring while everyone else chased the shiny thing of the year. That experience is why I treat every "this time is different" AI stock story with a lot of skepticism, especially when the macro backdrop looks like a Jenga tower. But then the unbelievable thing happened. There's also a weird upside in all this mess. Periods like this expose which systems actually help you and which ones just make noise. That's why this channel leans into automation with guardrails instead of hype. Speaking of that, this video was created with Fludge.io, the same system that powers this entire channel. If you're watching this thinking, "I'd love to run a YouTube channel like this, but I don't want to be on camera," that's literally what it's built for. It researches topics, writes scripts, creates thumbnails, uses an AI avatar, and uploads everything. You stay in control, jump in where you want, and over time it learns your style. It's not low-effort spam. If it were, you wouldn't still be listening to me talk about Japanese bond yields. If that sounds interesting, check out Fludge.io after this. Here's where things get interesting. Let's land this. The big picture is not panic, go hide under a rock. It's understand how fragile the system is when one country can't keep pretending debt is free forever. Japan is just the loudest alarm clock right now. The U.S. and Europe are not that far behind on the same road. For U.S. retail investors, that means a few things. Don't assume AI stocks are immune to macro. Don't assume bonds will always save you when stocks drop. And don't assume that because something is labeled government or safe, it can't suddenly go volatile when the math stops working. This is not financial advice. It's information so you can ask better questions. Talk to a qualified professional before making big money moves, especially in a market where algorithms and central banks can flip the table in a day. I'm curious where you stand on this. Do you think Japan is a warning siren for the U.S. or just another overhyped scare story that blows over? Drop your take in the comments. If you want more skeptical breakdowns of how AI, politics, and markets actually collide, hit subscribe, turn on notifications, and I'll see you in the next one.